On the agenda tonight, the European Union turns the table against the IMOB and charges them the rent.
For the rent.
And the souffle melts down, losing 7% of its value in a single day. Will CEO Elon Musk finally address the problem, or is he too busy repopulating the planet by impregnating his subordinate employees? Bank of America analyst Savita Submarine issues a new note saying, "Look at me, I'm bullish now."
I have no idea what I'm doing, but I know I'm doing it really, really well.
And Fed zombie from Atlanta, Raphael Bostic, makes a rare admission about interest rate cuts.
It's not gonna happen.
In a sign the bubbles are busting, YouTube bans the Maverick Wall Street again for showing boobies.
Boobies!
What?
Nothing.
All right. Today is Monday, the 4th of March. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Where do we begin? How about Maverick versus the man? Once again, you see, we spent hours last night doing a video, lots of research, lots of editing, lots of stuff being put together. Over an hour worth of commentary and analysis. And then YouTube, of course, bans the video and says that's going to be 18 plus. You can't see the video if you're under 18, and we're not going to monetize it. We're not going to show it in the algos. We're not going to show it in the main page. None of your viewers will get notifications about it. Oh, gee, why? It says, "Hi, the Maverick Wall Street. We have reviewed your content and determined that it may not be suitable for viewers under the age of 18 per our community guidelines. As a result, we have restricted the following content." And here's how they show it. They blur the thumbnail, which has Jerome Powell and a bubble blowing up. I guess Jay Powell's face is a show of debauchery, or it'll make you bust a major nut. But in reality, because we showed a picture of Sydney Sweeney's boobies, which millions of people, we now know millions of people, saw them live on national TV. Not only that, the link of the monologue and the boobies still alive and not censored or age restricted on the Saturday Night Live page on YouTube. Because those are the trusted sources where YouTube just doesn't even look. Yeah, everything you do is fine. But the common man, we gotta look at every tiny little thing so we can ban your videos. And this is why, folks, I'm just trying to talk you into moving to Patreon. We could put the public videos on YouTube and not give a shit about monetization anymore if everybody moves to Patreon. What is it with this fuss about Sydney's boobies? Did they hurt anybody? Of course not. It was one of the most viewed episodes of SNL in recent history, and the increase in viewership came from 99% male population. She knew what the audience want. She showed them. She did a good job with them, and everybody goes home happy. God bless America. I don't know what the problem is. I mean, nobody loves busting bubbles more than me, but not those kind of bubbles. And according to the rating agencies, the interesting finding is not that the increase in viewership came from 99% male. I mean, guys are more predictable than dogs. You say boobies, they'll show up right away. Actually, the most interesting finding by the rating agency, 99% of the 99% increase of viewership, they watch the show on mute. Wonder why? I have no idea. Can't explain that one. Maybe you can let me know in the comments. But anyways, folks, we got a lot of important things to cover. So let's move on. We begin with what happened to the IMOB. You see, they said, it's the Max 7, it's the best stocks in the world. Now the 7 go to the Fantastic 4, then the 3 Stooges, then whoops, what happened? They say, own Apple, don't trade it. Really? Maybe you should trade it. Maybe you should dump it already. It hasn't been trading really good. They have a problem with China. They have a problem with maturing iPhones, lack of innovation, lack of AI, and their racketeering revenue, the highest growth avenue for Apple, is now under pressure. Today we got the news that the European Union is now fining Apple $2 billion over the streaming service racketeering revenue. And this case, of course, involves Spotify. And listen to this. This is the 3rd largest antitrust penalty in the European Union's history. It wasn't supposed to be that way. It was supposed to be a slap on the wrist. But of course, a large corporation like Apple, you give them a slap on the wrist and they say, okay, it's a parking ticket, who cares? We're just going to keep doing what we're doing and have monopolies and destroy entrepreneurship in the App Store and charge the rent, and nothing's going to change. So you have to make an example out of them. And here it is. A basic penalty of 40 million euros was inflated, here comes inflation again, by a huge lump sum included as a deterrent, a first for the European Union's antitrust authorities. The European Commission charged Apple last year with preventing Swedish streaming service Spotify and others from informing users of payment options outside of its App Store, following a 2019 complaint by Spotify. And that happens all over the place. If you have a business and you have your app in the App Store, the IMOB will get a cut, the 30%. If you're paying Google, the man, because you want to be a member in the Maverick of Wall Street channel, well, guess what happens? Google gets the 30%, and then the IMOB gets the other 30%, and the Maverick of Wall Street left with shit out of his luck. Continuing, it said on Monday Apple's restrictions constituted unfair trading conditions, a relatively novel argument in antitrust case, and also used by the Dutch antitrust agency in a decision against Apple in 2021, in a case brought by dating app providers. It ordered it to stop such conduct. Apple said it would appeal the decision, a ruling at the Luxembourg-based General Court, Europe's second largest, is likely to take several years. Until then, Apple will have to pay the fine and comply with the EU order. The fine was nearly 4 times the 500 million euros sources with knowledge of the matter had told Reuters they expected the European Commission to impose on Apple. That's the shock value. Everybody said, oh, it's 500 million euros, slap on the wrist, no biggie. Then we get 2 billion. I wish they made it 4 billion. And now it's a major deal. That's going to take a huge chunk out of Apple net income. It comprised a basic element of 40 million euros described by European Competition Commissioner Margaret Vestager as, quote, a parking ticket, end quote, for the U.S. giant, plus 1.8 billion euros slapped on top as a deterrent. The 1.84 billion euros total is equal to half a percentage point of Apple's global turnover. Apple criticized the decision, saying in a statement it, quote, was reached despite the Commission's failure to uncover any credible evidence of consumer harm, and ignores the reality of a market that is thriving, competitive, and growing fast. No. You're charging 30% for nothing, for just facilitating a payment. And we don't really need you to facilitate a payment because we got Visa, MasterCard, many other options. Why is it that every time I want to do any transaction on my iPhone, which I already paid for, I have to cut you in? If that is the case, then the phone should be for free because you're making a lot of money from me doing transactions in that phone. And now Apple is using the card of, oh, this is anti-American. These are European countries that are jealous because they cannot innovate anymore. So now they want to charge our companies the VIG. The primary advocate for this decision and the biggest beneficiary is Spotify, a company based in Stockholm, Sweden. Spotify has the largest music streaming app in the world. It has met with the European Commission more than 65 times during this investigation. It said, that's according to Apple. Now, I'm not going to get into the bullshit of, oh, this is Europe versus the US and they're jealous and just charging our companies fines. I think they're doing the right thing. I think our regulators should crack the whip too, for the sake of U.S. entrepreneurs and smaller businesses. But of course, here in the U.S., the judges, the politicians, the media, all owned and controlled by Apple and the tech companies. Now, Spotify cheered the EU decision, but it said there were other issues in other areas. Quote, and while we are pleased that this case delivers some justice, it does not solve Apple's bad behavior toward developers beyond music streaming in other markets around the world, end quote. The company said in a statement. That's a good thing. Spotify's not just saying, yeah, we won and that's it. Screw everybody else. No, there are other problems where the IMOB is doing bad behavior in video game streaming, in small business transactions, in ticketing, and many more. But the bottom line, folks, now adding to Apple's woes. We talked about the risks for this company. You got China. That's a problem. China is in a recession and revenue is not growing as before. There is a sentiment in China that why would you buy phones from the enemy? The company has no AI innovation. And I mean, what is AI? What is the implementation of AI in Apple? I mean, we already have Siri. Oh, AI is going to add filters to my pictures on the iPhone. Okay, yeah, that's great. Let's add $17 trillion to the company's valuation. They wasted a lot of money on the stupid goggles and useless iMacs, and the only avenue left for growth is the racketeering revenue, aka the services revenue. And now it's coming under regulatory pressure. So when it rains, it pours, I guess. And it wasn't just Apple today. It was also the souffle Tesla. The headline reads, Tesla stock stumbles or tumbles. Stumble, then tumbles. 7% as shipments slump. New price cuts announced in China. Uh-oh, we have a problem here. Look at the shipments from China, trending down. That's not good. Tesla reported 60,365 vehicle shipment from its Giga Shanghai factory in February, according to preliminary data from China's PCA, Passenger Car Association, via Bloomberg. The February shipment represents 16% drop from a month ago. Wow. A 19% drop from a year ago. This is the lowest shipment total since December of 22. So we already knew about the lack of demand in China. That's a problem not just for the souffle, not just for Apple, but for Nike, for Starbucks, many other companies. Yum Brands, it's the same problem. The only consumer that is still spending in China is the affluent consumer. Think about LV, think about luxury brands. Those are doing okay for now in China. But it's also the margin problem for the souffle. If they continue cutting prices, then margins will keep going down and down and down. Now, does the company have any choice at all at this point? Because their input cost is really high. Wages, you see the labor problems in Berlin, in Sweden, in Tesla factories all over the place. The cost to manufacture the car is going higher because of raw material costs, transportation costs, the Red Sea problems. But they cannot pass that extra increase in input costs to the end consumer. And the reason is demand is down. The market is already saturated with souffles. Everybody who wanted one got one. Now the company has to eat the increase in input cost. Bad combination for the company. Continuing. There's another problem here, and here it is. The competition is fierce in China's EV market, and Tesla having to cut prices and possibly reduce shipment is definitely a concern for investors. Now we have NIO reporting in the morning tomorrow. That's going to be really interesting. If we see NIO eating market share from the souffle, we could see Tesla going down even more than the 7% that we saw today. And perhaps Tesla should be thankful that they're lucky that we have here in this country. Anti-business practices. We claim that we are a capitalist system or a free market economy. Not when it comes to Chinese companies, though. We want to sell our shit in China. Apple phones, Nike shoes, Tesla cars. But when Chinese companies want to sell their phones and their cars here, we say no. National security. Competitive problems. But at the end of the day, you want to reduce inflation. Allow Chinese cars to enter the market. That's going to reduce the entry cost for buying a vehicle here for the U.S. consumer. They get to buy a BYD car, a NIO car, for a fraction of the cost. Good for the consumer, problem is not good for U.S. companies, aka the donors to the politicians, and of course not good for the U.S. worker. So it's a double-edged sword. Good for the consumer, not good for the American worker and companies. Concerns about BYD entering the U.S. market was growing as the China-based automaker was reportedly going to use Mexico-based factories to import EVs into the U.S. without a tariff penalty under the terms of the U.S.-Mexico-Canada agreement. If that happens, if BYD enters the U.S. market, say goodbye to Tesla, not just Tesla, but Ford, GM, they're all going to go down. In a real competition with Chinese manufacturers, they won't last. Look at what's happened to their market share in the Middle East, or in Europe, or in Africa, South America. They're losing market share like you've never seen before, the Chinese manufacturers. But the bottom line, folks, now we lost Apple, we certainly lost Tesla, we're losing Alphabet, and now the market is reliant on NVIDIA, the chip mania, maybe Eli Lilly, the Ozempic mania. What else? Amazon? Meta? Microsoft? These stocks stalled, the three. Meta, Amazon, Microsoft. Who's going to do the lifting here if, say, the chip mania goes down? Because of all of these concerns about China, or because of cost pressures, or because the Fed will raise rates from this point on, or because we see weakening in the economy because of recession, or bank failures. Look at what happened today to New York Community Bank. Down double digits. I think the bank will collapse. Just a matter of time. And that leads us to the next story, which is Atlanta Fed zombie Bostic came out today. And he said that he sees the Fed pausing after just one rate cut in the third quarter. Wow, that's kind of specific. Third quarter, that's the election season. One rate cut, then we pause. What's happening here? How do you get this specific? Because Bostic in the past said, oh, rate cuts will happen in 24. Then it became, oh, the summer of 24. Then Q3 of 24. Then Q4. Then it's going to be 25. Then never. Not going to happen. Until, of course, the shit hits the fan. But this is kind of weird that he says the third quarter we do one and then we pause. See, the market is pricing in 6 rate cuts this year. Beginning this month of March. The Fed was doing 3. Now zombie Bostic says 1 and then we pause. At the end of the day, folks, they know nothing. They have no idea what's going on here. He adds that the Fed has the luxury of making policy without pressure of urgency. Oh, really? See, when we were waiting for you to tackle inflation properly and raise rates, oh, you had the luxury of waiting. But if the stock market goes down 10, 15, 20%, oh, you're going to feel the urgency right away to begin cutting rates, despite the fact that the price will be a revival of inflation. And ladies and gentlemen, it comes down to this. The Fed always makes the same mistake. They raise rates too late, they cut them too late, or they cut them too soon, and they get inflation back again in the picture. We've seen that back in the 70s. We've seen that again in the GFC. We talked about this numerous times in this program. Look at what happened to oil prices in 2008 when the Fed began cutting rates in 2007. So it is just a matter of when. Because you have this stagflation combination. At some point, a bank is going to blow up. Could be tomorrow, could be this week, could be next week. And then we see contagion in the economy. We see commercial real estate beginning to show signs of blowing up. Banks, stocks begin to fall rapidly. Then the Fed says, okay, we're going to cut rates. Here we go. What do you think will happen with the services inflation remaining hot? Oil loves rate cuts. And today we got the news from OPEC that they're going to stay with their production cuts all the way to the summer and beyond. Which means the moment the Fed cuts rates, oil is going to surge like you've never seen before. Maybe you've seen it before in 2008, but not since. And you got these mega cap companies. They're continuing to spend and producing inflation in the services sector. You got the fiscal government also spending and producing inflation. So the moment they cut rates to save the banks, we're going to get a massive surge in inflation. And then the Fed will be in panic mode. What do we do now? So this is the calm before the storm. This is not Goldilocks. This is not soft landing. You morons. I'm not talking to you. I'm talking to the so-called analysts all over the place. For example, look at Savita Submarine from Bank of America. She was a famous bear for the most part in 23. Then she flipped to bullish because, of course, you can't have an opposite opinion in Wall Street. You can't be with the cool kids holding a bearish view, even if at the end of the day you're proven right. Look at what happened to Mike Wilson. Maybe he's going to be right at the end of the day, but he cannot survive in Wall Street. So now Savita Submarine comes out and says that she's boosting the S&P 500 to the highest in Wall Street. Higher than Thomas Lee, higher than Ed Yardeni, higher than all of these cokeheads who are giving outlandish targets. Savita Submarine from BofA raised her S&P 500 year-end target to 5,400 on Friday, implying 5% upside from here. She cites, quote, surprising margin resilience, end quote, and better economic outlook globally, but warns that the likelihood of a near-term pullback is high. Now, this is all bullshit. She's giving you an outlandish upgrade to the market, but if we go down, I said we're going to pull back. Here's the problem. What if it's not a pullback? What if the so-called pullback morphs into something else? Stop speaking with both sides of the mouth as an insurance policy. Is it going higher or going down? Wouldn't it be nice if these analysts would actually let us know what's going to happen beforehand? Wouldn't it be nice if all of these analysts who are now upgrading NVIDIA's targets, wouldn't it be nice if they told us that back in 22, early 23? All they do is just chase the price. The price goes higher. Oh, now we're upgrading and we're saying we're going to go higher, and fill in the blank whatever reason we're going to give. Margin resilience or global economic whatever. But here's the problem for these analysts, specifically those who flip-flop like Savita Submarine. See, about 9 months ago, she said that you don't want to buy mega cap technology stocks. You got to stay away from those. Well, we all know what happened to them. She feels bad. She doesn't know what she's doing. Her analysis says that you got to stay bearish, but the market price is doing something else. So she says, you know what? I like my job. I like appearing on TV. I want to go to the parties. I want to be one of the cool kids in Wall Street. So I'm going to just flip-flop and be as bullish as I can, as clownish as I can. And she goes on and says the idea that the market is too expensive should be debunked. Wait a minute, Savita, you said 10 months ago that you shouldn't be buying the big caps because of valuation concerns. All of a sudden now the market is not too expensive? What's going on here? I know what you're going to say. You're going to say, but at least Maverick, she flip-flopped, sure. But she made a correction. She was wrong and now she's following what the market is doing. You're the one who's stubborn. You're the one who's not changing his mind. How would you feel if I come out right now and say, hey guys, by the way, the market's really cheap and we're going higher. This is the beginning of a bull market. We're going to be back at 10,000 by the end of the year. Going to buy NVIDIA right now. And it's not about being stubborn. It's about what the analysis shows. And so long as the analysis leads to a bearish conclusion, we'll follow that, regardless of what the market does in the short run. The market has been wrong many times before, creating these bubbles, and then the bubbles go down, crashing. And then investors complain and say, how come nobody told us? How come nobody told us that this is not going to last? That this was a trap, this was a bubble? We're not saying have no exposure to the market at all. You can invest, you can chase the bubbles if you'd like, but with the mentality and the understanding of the inevitable in the economy, number one. Number two, the fact that we are in a bubble. Bubbles are dangerous. They can be fun to chase during the right time, but if you chase them in the wrong time, it could be disastrous. If you don't have the emotional discipline, if you're going to fall in love with these stocks because you're seeing your paper gains go higher every day, you're not going to be able to get out. You'll see the beginning of the crash. You're not going to get it. You'll say, oh, this is a pullback. We're going to go higher again. It's the same trap, the same problem in every bubble that we've seen before. Would have been great if Savita Submarine said, you know what? I see the economy heading in a recession either way because we have stagflation, and for the Fed to really remove inflation out of the picture, they need to raise rates properly and cause a recession. And a recession is not good for stocks. Stocks are going to go down crashing. In the meantime, we have an AI bubble, we have big cap companies spending, we have fiscal spending, and that might keep equity prices higher. So here's what you got to do. But of course, you can't say that in Wall Street. You got to be bullish, 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 bullish. You can be bearish for a short amount of time, but when there is a bubble, and the bubble in a nutshell is a transfer of wealth from the retail crowd, from the investor class, the retirees, to the oligarchy and the Wall Streeters. You don't have to look back at the dot-com or the GFC, just look back to 21. They got early on to the Zooms and the Pelotons and the SPACs. They created the bubble, and the bubble was to lure in retail investors, fluff up these valuations beyond imagination, and then send your dogs on CNBC and the media to say, oh, this is normal, this is new, this is different this time because fill in the blank. Then they cash out, and the bubble goes down, crashing on the heads of the innocent, the naive. And now they gave you the sexiest bubble of all time. The names that you know, the biggest cap technology companies in the world, they gave you nice buzzwords like AI. But the problem is what they don't realize, or maybe they do, and now they're panicking because they've created Frankenstein. There is no amicable way of popping this bubble. You can pop the bubble in the small caps, in the IPOs, in handful of technology companies, in the stay-at-home stocks, and everything will be fine after that. But this is too concentrated. This is too big to fail. And I think now we're going to begin to think about that. What happens when these names go down? I don't think we can recover fast from it. And this is why we say you got to invest with the understanding of the nature of what's going on in the market and the nature of what's going on in the economy. And then there will be a time to short all of these bubbles, and there'll be more money to be made on the way down than the way up. But this is really interesting that the bears are now flipping. Even Dr. Doom, the most bearish analyst of all time, Dr. Rubini, now says that he's less worried than the past, that a soft landing is a real possibility. This is the problem with Wall Street, that even if you're right at the end of the day, even if your analysis leads to the right conclusion eventually, you're not going to survive. Not just in Wall Street, even here in YouTube. You can't continue to hold that view. It'll cost you. Viewers will go away, you're not going to have any money anymore, and you're going to have to give up, even if you end up being right at the end of the day. But the problem that I see with the flip-flopping is if you flip to bullish, just to appease the audience, despite your research, despite your analysis, if you do that, and then you end up being right, how do you flip back? Hey folks, by the way, we're going back to what I said before I flipped to bullish. Where's the integrity in that? You think folks are not going to catch up to the fact that you did all of that flip-flopping and you have no credibility at all? And at the end of the day, folks, it comes down to what the data and the analysis says. If it leads to bullish conclusions, we'll be happy to do so. But so long as it leads to a bearish conclusion, how could you? Just because the price action is going one way, you're going to ignore everything you see in reality? All of the patterns that you've seen in the past, you see them right now, you're going to ignore all of that? I can't do that. Anyhow, let's move on to the session today because it was really interesting. All in all, it was muted, but the intraday action was really interesting, specifically in individual names. Now, I want to remind you that we produced an options tracker video in the morning. We discussed trades that we have open and closed for XBI, for Apple, Adobe, eBay, many more. So you have to watch that, but we added more and we gave you more updates throughout the day in Discord. We begin with the morning brief. Here it is. Good morning. Nothing on the data front today, so we are watching the 1 hour MACD on the SPY correcting overnight. It might reach 510, then find support. In any case, I want to take advantage of this setup by playing a quick pullback trades on charts that are gapping up in the pre-session. This is a risky strategy, so consider that. The idea is we have charts already gaining in the pre-market session, and as the regular session begins and algos correct the index, that's the SPY, these names drop too. Complicated theory, but I've seen it before many times. So we look at SMCI Super Micro. If it opens at the prior high, 1080, I want to take the shot and buy weekly 970 or 950 puts and close them quickly upon the first pullback. If this scenario takes place, then we will reassess whether a longer trade is suitable or not. Now here's the chart, the 5-minute chart for SMCI. We did not open at 1080, but we got there. And yours truly took the shot either way because I thought we might get a rejection at 1080. You see the struggle that we got at around 1080 for a few minutes. Then we passed above. We closed above. From a 5 minutes perspective, what is the discipline? The discipline is you take the trade off the table. You take the loss because you might get it later on. But if you stick to that trade, the decay will be big until you're right again. Not a lot of traders have that discipline, so we closed it once we got a 5-minute close above 1080. By the end of the day, the stock makes a round trip and comes back closing below 1080 at the end. So is the trade back on track? Well, let's look at the daily chart. The last time we got a gap higher above the upper Bollinger Bands, the bear was waiting there. We got a nasty correction. Now we gapped above the Bollinger Bands again. Was the bear waiting there? I think there is evidence that the bear was there, and we might see the stock dropping tomorrow, despite the fact of the inclusion in the S&P 500. We still have no evidence to get back into that trade. We need to see a rejection. Today we saw a loss, not a confirmation that we have no energy to trade above 1080. That might come back tomorrow. We might see weakness in chips overnight. I'll show you that in a minute. But we talked about ARM. On the 4 hours chart, we see a triangular consolidation pattern with bullish confirmation above 151.76 and bearish below 132. If ARM makes a bullish confirmation, I will close the 130 puts I open on Friday. Otherwise, I'm doubling down, especially if I see a drop upon the open. Now, on Friday, we talked about the relative weakness in ARM because every chip stack went higher, ARM was flattish. And then we have the dumping by SoftBank this month. They'll be allowed to book their profits. So the theory goes, watch out, a big whale is about to dump, and folks will book their profits before SoftBank is able to do so. Here's the chart of ARM, daily chart. You can see that we have a triangular pattern. You break above 151.76, you have more gains to come. You break below 132, you got more losses to come. And you look at the MACD, we're losing a lot of momentum. But if we zoom in to the 5 minutes chart, here's what we got. We got the gap and crap. We gapped higher, then we crapped right away. So we averaged down in the trade, and now the trade is profitable. So you take the opportunity when you see it, that we have a gap higher, but the SPY is about to do a correction in the 1 hour. Combination of both. We've seen this time and time again. You take the shot, and in this case, it paid off. Then we talked about Tesla, the souffle, not a chart that is gapping higher in the pre-market session, but rather showing weakness. A drag in the index could cause more damage to this chart. If I see the chart losing 196.26 today, I will go with the 195, 185 March 15 puts. So we look at Tesla. This is the chart that I gave you, the 1 hour chart. Here's the update. Look at this massive flush down. We lost 199.90 right off the gate. That was warning sign number 1. But you see the retest to 202.5. That was the setup as the warning sign. Then we retested 202.5. Then we lost 199.90. Okay, now you know for sure that the chart doesn't have the energy and it's about to lose ground. But you need more confirmation. And that confirmation came from 196.26. We lose that, boom, you got a bid right away. Not only we lost 196.26, but we lost 190.59. We might even lose more. We might lose 185 tomorrow. But the trade was so profitable, massive gains in a short amount of time, so we gave you a note. Folks, if you followed the Tesla 195, 185 put trade from the morning brief, I'm closing it right now. Could go down further, but it's too oversold in the short run. In, out, hello, goodbye. Steak and lobster, baby. We'll look at the chart again, the charts analysis. Maybe we have more opportunities coming, but we also gave you a note for the crypto miners at around 8:49 a.m. Pacific time. Crypto miners not looking so hot so right now. Clear relative weakness. So Bitcoin was higher, but the miners were down. If Bitcoin tops and reverses, they'll crash. I will begin to add incremental naked puts on them with March 15th expiration. This is a risky play though, due to the high beta nature of these stocks. So do your homework first. I'm targeting drops in the range of 10 to 15% to break even when picking my strikes. Folks, we talked about this last night, that now the miners will begin to become really risky. We might see them crashing. And the reason is the ETFs from BlackRock will crush them because there is no need for the miners anymore. When you have BlackRock ETF, there's no fundamental reason for the miners to go higher besides just tracking Bitcoin. Why would you need them anymore when you got the BlackRock ETF? So here's what happened. We look at MARA, Marathon Digital Holdings, 5 minutes chart. If you look at the note, we gave it at around 8:45. Since then, the stock went down by more than 7.5% before rebounding, but again, it's a bad look. Look at it again in the charts analysis. You look at RIOT, since we gave the note, it went down by about 3.75%. You look at CleanSpark, another miner, CLSK, since we gave the note, it went down by more than 5%. And I believe that we have more losses to come. We'll look at all of these charts in a minute, but we gave you another note at around 10:26. I said, keep your eye on the big picture. I showed you the MACD indicator. You remember what happened last week, what we saw in the intraday charts. Perhaps a gap and crap, perhaps a reversal sign. I told you, be careful on the hourly chart. The momentum is still bullish. Do not fall in a bear trap. Today, the message was, Do not fall in a bull trap because the momentum is changing from bullish to bearish, regardless of what the 5 minutes chart does or the 3 minutes. Keep your eye on the big picture. Look at what happened today. So last week we got the bear trap, gap and crap. Folks are saying, okay, down we go. Today we've seen the same thing. Oh, we have a breakout now. We're back at the highs. Folks buy SPY calls, 0 DTEs of course, and boom, we flushed down. Turns out it was a bull trap. Well, gee, why did that happen? We zoom out to the hourly chart. Look at the MACD indicator. In the bear trap, the momentum was shifting from bearish to bullish. In the bull trap today, the momentum was shifting from bullish to bearish. Keep your eye on the big picture. Then we gave you a note at around 11:30. Folks, if you followed the NEM trade, this is for new amount last week. I'm closing it right here for triple-digit gains. We're talking about 300% worth of gains. I would love to hold it more, but gold is trading like a meme stock right now. There is an hourly resistance at around 33.19 too. If you still like it, consider rolling to a longer expiration and higher strikes. We'll look at gold in the charts analysis, but when you have gains like this, and the hourly RSI is way overbought, and you have 1 week till expiration, you gotta be disciplined. You gotta book your profits. Likewise, at around 12:22, we gave you another note. If Apple crosses above 175.63 on the 15 minutes, you have to close your March 15th 180-170 puts. The 185-175 would still be okay, but I would consider rolling to the 180-170 for April monthly expiration. Now, we closed below, but again, if you had the 180-170, booking profits today was not a bad decision. You can always roll to a newer expiration, but we don't want to be too greedy here. We'll look at Apple again in the charts analysis. Maybe we have more downside to come. But I'm also going to show you some data in the options market coverage where folks are making bullish bets on a rebound for Apple. So you have to consider all of that data and not be too greedy. Then around 12:45, we gave you another note. I'm starting to like this trade. AMD 190 calendar put spread. Buy next week, sell this week. For about $1, I'm going to pull the trigger. Do your homework before following for $1. And you could have massive profits if AMD goes down and closes a notch above 190 by the end of the week. And by the end of the day, folks, we've seen weakness in the chips, not just Supermicro reversing or NVIDIA reversing, it was also AMD. So there is a major chance that we could see a correction beginning tomorrow in the chips. And if that is the case, if we go down to 190 but not close below 190 by the end of the week, the trade could produce gains of 300, 400, 500%, and we're only risking $1. That is $100 because you buy them in contracts. Each contract has 100 options. Okay, this is a good setup for the next segment, which is the market coverage. We begin with the closing of the indices today, and here we go. The diamonds in the red by 97.55 points, or a loss of 1/4 of a percentage point. The Nasdaq leading the pack to the downside, losing 67.43 points, or a loss of 0.41%. The Spider down in the red by 6.13 points, or a loss of 0.12%. And the IWM, the Russell 2000, down by 0.19 points, or a loss of 0.9%. The sectors, a lot of questions today on Discord. What is the theme, Maverick? It's really weird. So it was a theme betting on, oh, yields are going down, the dollar is going down. But you look at the charts of yields and the dollar, they're not down by much. Utilities, yield sensitive at number 1. REITs, also yield sensitive at number 2. Then you got materials, dollar sensitive at number 3. Pay attention now. We're not seeing the weakness yet in bond yields and the dollar. But I would say that the action in gold today was really alarming. What is gold sniffing? Why is gold rallying and surging higher like this? I think that maybe, at least for today, gold was sniffing a bank failure coming soon and a major drop in the dollar and bond yields. Because utilities, that's also defensive. I have no evidence that the market is going to be right or wrong. To be honest with you, I don't know if a bank failure is going to happen, whether the dollar is going to go down or bond yields flushing down. I think that we got Jerome Powell with the testimony in Congress. He could be hawkish and lift bond yields and the dollar higher. But it is really interesting that the market is beginning to sniff weakness in the dollar and bond yields. Not for the good reasons, though. The laggards, comm services, cyclicals, energy, the risk-on segments of the stock market. We look at the breadth NYSE, 45% advancing versus 54% declining. The Nasdaq, 38% advancing versus 59% declining. So it wasn't really bad of a breadth, even though the Nasdaq was down. Why? Because, again, the big caps are down, but other names in the Nasdaq were going higher. It is really a weird phenomenon that the indices love bad breadth, rallies by the big caps, by the highest weight stocks. But somehow when the breadth actually broadens and we see outflows out of the big caps, you get the indices trading negatively. Someday we're going to look back at this behavior and say, how come nobody really noticed all of this? Anyhow, moving on to commodities. The dollar was flattish, slightly down, but look at the massive reaction that we see in gold, silver up over 3%, platinum up almost 2% for the day, copper absent from the rally along with palladium, so mixed messages. I would say that the precious metals, the defensive metals, were higher, and again that solidifies my theory that the rally today in gold and silver is not because of the dollar going down. It is because they're sniffing something bad is about to happen. When it comes to softs, again, nothing's stopping cocoa now. Rebounding big. It might make it back to the highs. Since we've seen Supermicro making it back to the highs and Nvidia surpassing the highs, maybe cocoa will make it back to the highs and then some. Nice rebound for OJ, gains of about 2%. Coffee, nice gains, north of 1.75%. We see lumber also gaining about 1%, but sugar continues to bleed here, losing about 2.5%. It was a pullback day in energy. The WTI down about 1.5%. Brent down about 1%, so did the gasoline RBOB, and diesel down a little over 2.25%. What's up with that? We got the cuts from OPEC. Now, folks would say the reaction was negative because the cuts were not as deep as anticipation. I disagree. I think this theme that we've seen in oil, the weakness that we've seen, has been from the get-go, and it ties hand in hand with the action we've seen in gold and silver. Some commodities traders are sniffing a bank failure really soon. A drop in the dollar big time, a drop in yields big time, massive surges in gold and silver, big drops in oil, a recession kind of behavior. We'll see. I have no evidence, but I'm just analyzing for you. Then we've seen nice gains for natural gas, worth about 5.5%. Now we got the news that EQT is also reducing the output, so supply goes down. Now we see prices recovering. If that theme continues, it'll be good for natural gas, good for stocks such as EQT. Moving on to the big casino, the options market, what do we see here? The hottest tables, Tesla, Nvidia, Apple. Tesla now reclaiming number one from Nvidia. The bias is still for calls more than puts, but other tables were kind of empty. You talk about Alphabet, you talk about Marathon, you talk about Amazon. So the action is becoming narrow and limited because a lot of options are becoming super expensive at this point. And even if you're going to trade Tesla and Nvidia, you'll pay a lot. It's the high roller table. So folks are just holding the options for a day, for a few hours. They make a bit of gains and then they pull out. Maybe a sign that the market is topping out. We need a correction. We need to see premiums becoming reasonable again so we can get some action in the options market. Now it's just too expensive. When we look at the flows, really interesting. We have over $50 million of bullish flows for Apple today. We have over $69 million of bearish flow for Nvidia. When we look at the details, for Apple, for example, they sold the 195-200 puts. This was a major trade, about $13 million. Somebody sold the 195 puts, the expiration date of March 15th, for about $18.5 million. The bet is that Apple will be above 195 by the expiration date. Doesn't mean that they're going to be right, but it means that you have to be aware that if you made some gains via your Apple puts, don't be too greedy. Book some profits. Oversold rebounds will happen. Extend the expiration date. Roll some. Trim some. Do some de-risking strategies. You're a counter-trend trader when you're buying puts at this stage. You cannot afford to be too greedy. If you're betting with the trend, you can afford to be greedy, not when you're a counter-trend trader. When we look at the flows for the SPX, this is really interesting. Almost $15 million buying the 5,100 calls, expiration date June 21st. On the other hand, you have somebody selling the 5,000 calls, netting about $10 million for April 19th. So we have a divide. Major bets, one for the upside, one for the downside. I think the SPY is getting really near a major correction, the biggest one since the month of November, really late October of last year. Anyhow, we have to move on to the unusual activities because we have a lot of them today. We begin with AIG. This is the insurance giant, at least used to be. I mean, you look at the chart, the monthly chart. Got the inverse in his shoulder. Now it's a steep rally. It may be a rising wedge. Maybe we see the stock going down. But then we zoom out to the monthly chart again, and folks who say time in the market beats timing the market. Well, look at what happened to this chart. We all remember what happened back in the GFC and the crash of AIG. A lot of folks, the younger folks who did not trade back then, they have no idea. They think that everything goes to the moon, every dip is buyable, and the market will never go down again. The higher they go, the bigger the crash, and the longer they stay down. Anyhow, the trade for AIG We have to read it from the buyer's side, but looking at the chart with the rising wedge, I think somebody's selling the 80 calls just to raise some cash. Somebody who owns AIG stock. But again, I have to read it from the buyer's perspective. We always do that because the majority of these trades are initiated by the buyer. So in this case, somebody bought the 80 bucks calls for the expiration date April 19th. The expectations AIG will go higher and gain more than 9% by then. Paid about 50 cents a piece to enter this trade. All in all, spending about $1 million. And then we have the SPY. Somebody's betting on a correction for the S&P 500. They bought the 481 puts for the expiration date March 22nd. The expectations the SPY will go down and lose more than 6% of its value by then. Paid about 50 cents a piece to enter this trade. All in all, spending about $650,000. And then we have the trade for the ticker CTVA Corteva. I happen to own the stock, and somebody here is buying a put, so I gotta follow this trade as a hedge. When I look at the chart, daily chart, maybe we're looking at an inverse ABC pattern. If we lose 52.76, probably we got a confirmation for that. So we go back to the trade. It's the 50 puts, expiration date April 19th. The expectations, Corteva will go down and lose more than 7% of its value by then. Paid about 50 cents a piece to enter this trade. All in all, spending about $350,000. Then we have the ticker FUTU, Futu. And this is not the Chinese Kodak. They do nothing in relation to photography. It's actually a financial firm. FUTU. I'm not cursing at you. But this is for Futu. And somebody bought the 60 calls for the expiration date April 19th. Expectations, FUTU, will move higher and gain more than 7.5%. But look, now YouTube is going to demonetize this video because I'm cursing at you. Anyways, up by 7.5% or more by then. Paid about $3 a piece to enter this trade. All in all, spending about $1.8 million. Then we have the ticker ALLY for Ally Capital. Lots of bad loans. But the big buffet's buying those. I don't know what happened to him. A lot of traders see opportunity in Ally, to each his own. Somebody bought the 42 calls. If we look at the weekly chart, I mean, it looks okay. You got a double bottom. You're above 35.78, but you also got a rising wedge and a loss in momentum in the MACD, weekly MACD. We lose 35.78. I think the chart begins to crap. So we go back to the trade. Somebody bought the 42 calls. And again, it could be an owner of the chart who's just selling covered calls. But we have to read it from the buyer's perspective. 42 calls, expiration date May 17th. Expectations, Ally Capital will gain more than 14% by then. Paid about 85 cents a piece to enter this trade. All in all, spending about $500,000. Then we have the ticker DELL, Dell. Stock moved by over 30% after earnings. Somebody's fading the rip. They bought the 115 puts for the expiration date March 15th. Expectations, it will go down and lose more than 5.5% of its value by then. Paid about $1 a piece to enter this trade. All in all, spending about $550,000. Then we got Tesla, the souffle, and somebody bidding for more pain to come. They bought the 170 puts for the expiration date April 5. Expectations, Tesla will go down and lose more than 9.5% of its value by then. Paid about $3.35 a piece to enter this trade. All in all, spending about $1.8 million. Then we have a lot of bets against chips, whether be it NVIDIA, be it AMD. Now we have the SMH, which is heavily weighted by NVIDIA. Somebody bought the 212.5 puts for the expiration date March 15th. Expectations, the name will go down and lose more than 5% of its value by then. Paid about $1 a piece to enter this trade. All in all, spending about $450,000. You look at the daily chart. We have a gap outside of the Bollinger Bands, in this case, the upper Bollinger Bands. 9 out of 10 times, the following move would be a pullback because there is a big fat bear waiting out there. And the chart will be scared and pull back within the Bollinger Bands to avoid the bear. That's the theory. So when we look at the next trade, the last one, DASH for DoorDash. Look at the chart again. We have a gap outside of the Bollinger Bands. We got a big bear waiting outside. You don't want to do that. You want to pull back within the Bollinger Bands to avoid the bear. So again, maybe somebody's selling covered calls, but again, we read it from the buyer's side. So somebody bought the 155 calls for the expiration date, May 17th. Expectations, DoorDash will rally higher by more than 17% by then. Paid about $3.80 a piece to enter this trade. All in all, spending about $1.7 million. Moving on to the heat map, what do we see here? The breadth was not really that good today, and the majority of the weakness came from the large cap stocks. Apple, Alphabet, Tesla, Chinese names. And really interesting, not just the Baba, Pinduoduo, and JD, but also any China-related names, such as Nike, such as the travel names, Li Auto, such as Starbucks, even the pharmaceutical names that have any connection to China, like Merck, Pfizer, all down for the day. We have weakness in energy. We talked about Chevron being dog shit right now. a drag on the XLE. Exxon doing fine, the refiners doing fine, but Chevron made a huge mistake by at least announcing buying Hess. I mean, Hess was a really good stock. They have ruined it for all of us. A nice momentum energy stock. But we see the financials also pulling back. Not the banks or the regionals for now, but the credit card companies. We see Berkshire Hathaway continuing to do the correction that we talked about. We nailed it pretty much at the top. I think that we have a little more to come in Berkshire Hathaway. You got some of the software names down, such as Workday, down big, Square, Palantir. In the chips segment, you see that ARM is down in preparation for the dump by SoftBank. But then you got the AI mania, Nvidia, Taiwan, and really weird, Intel. Why would Intel join? I mean, they reported earnings, the stock went down. We talked about the AI earnings. They were dog shit, so why would we buy Intel here, besides stupid and rampant speculation? Then you have some value names that folks and some managers are migrating to as a substitute for the AI mania, for the names that went way too high, such as IBM. So you got to keep an eye on that name. The Ozempic mania is still hot. Eli Lilly, NVO. In healthcare, we've seen the medical devices coming back. Abbott Laboratories, Medtronic, EW, Edwards, Life Sciences. The gold miners are hot in metals, utilities, real estate, the industrials, mixed, but mostly in the green. Names like GE, Eaton, I mean, they've been on fire with no stop, no corrections at all. What happens when these names go down? I think it will be a massive gap down all of a sudden. So you got to be really careful chasing these names that went way too high too fast. Let's contrast this with the heat map from the ETFs. What do we see here? The TLT was negative, meaning that yields went higher, believe it or not. Even with that, we see the XLU, yield sensitive, going higher. We see the IYR, real estate, going higher. I think most of that because of inflows and technicals, not really because they're tracking the bond market. The XLU could be a defensive theme, though, and it goes hand in hand with the GDX called miners, GLD, SLV, as a defensive formation, buying gold and silver. You see the outperformance by value, IWD, and mid-cap. MDY, underperformance by large cap growth and small caps. So right off the gate, you know this was a defensive theme. You look at the Chinese equities, those are down. Again, that's a risk-on segment of the map. Those are all down. The only risk-on that is up, besides the SMH and SOXX, the chips, which they could be going down tomorrow. We see the crypto ETFs, GBTC, IBIT, BlackRock, BITO, all higher for the day. But I have a hunch that even these Bitcoin ETFs will go down big this week. We're going to see a major correction in Bitcoin. And until then, let's move on and do some charts and then wrap it up. We don't have a lot. I mean, from intraday perspective, we got a lot, but on the daily charts, nothing. So look at the hourly chart for the SPY. Keep an eye on the big picture. What do we see in the daily MACD? We're going to go down in a correction. So let's go down and just retest 510, see how it holds. If it holds okay, good to go. Doesn't hold, then we have to go down and seek a better support, and I got 507.75. We can talk about that if we lose 510. Daily chart, any update? No, we got to the upper Bollinger Bands, faced some resistance. That's all there is. You look at the hourly chart for the E-mini futures. Any update here? Not really, but maybe a sign for weakness to come via a bearish engulfing candle. Now we need to lose 5,092.5. We need to lose 5,022.5 before we can talk about, okay, now the bears are making a comeback. For now, the bulls remain in charge, despite the action that we got today. You look at the Qs, hourly chart, again, big picture. Look at the MACD, correction, sure. Can we go down to 440.59? Yes. That would be the healthy thing to do. Seek support, see how it holds. If it holds okay, higher we go again. If it doesn't, then we have to go down, maybe 435. Retest that again. If we do, it's going to be a worrisome sign that we're losing energy, we're losing steam. For now, the daily chart, all what we've done is going up to the upper Bollinger Bands, facing some resistance. That's all there is. There's nothing special here. Daily chart for the NASDAQ E-mini futures, what do we see here? Nothing really. I mean, we're above all of the important levels in the chart, and we're not really overbought, and this could be, again, another bull flag consolidation pattern. We need to lose the trend line. We need to lose 17,735.75. Then we can talk about, okay, we're breaking trend. Now it's getting serious. Looking at small caps, the IWM daily chart again, we're above the important numbers, 205.49. We just got a retest of the upper Bollinger Bands, and we got a slight negative reaction. That's all there is. We lose 205.5. We lose the 20 days moving average. Then okay, we got a reversal. We can play it all the way down to the lower Bollinger Bands in or around 200 even. We look at the dollar again. No major drop in the dollar, just consolidating in range a little below the 20 days moving average. But then you look at the old man gold, massive pop outside of the boundaries, above 2080, above the upper Bollinger Bands. Gold today acted as Bitcoin, acted as a meme stock, as a momentum stock. This is weird for gold to do all of this. Either it is a false signal. We're going to see the dollar going higher and gold flushing down in an overbought correction. Or is the old man sniffing something bad about to happen? Regional banks. I have my theories, but if nothing happens overnight, then you look at the GDX, way overbought in the short run outside of the upper Bollinger Bands. Probably in the morning brief, we want to take a shot and a pullback in the GDX. Preferably the SLV silver. That's way out of whack, way outside of the Bollinger Bands. The dollar makes a comeback. We're probably going to have a trade on it, betting on a pullback here, absent of a bank failure overnight or through the session tomorrow. When we look at the weekly chart for Brent oil, what do we see here? Nothing really. We're consolidating in a bull flag pattern underneath 85, but we need to pop. We need to release the energy and trade above and close above, most importantly, 85. Otherwise, we're going to run out of energy and lose the 20 weeks moving average. That will be problematic. Of course, if there's a bank failure, energy is going to flush, no doubt about it. Then we look at the XLE weekly chart. Again, we got to the upper Bollinger Bands. That's all there is. We got a negative reaction, but no reversal, no signs for worry, at least for now. If we lose the 20 weeks moving average, then we got a problem. For now, consolidation, booking profits in the meantime. If we consolidate for a little bit, the energy will be released to the upside, absent of any bad economic news. You look at the refiners VLO, I'd love to be in the refiners more than the XLE, to be honest with you. You see VLO is now knocking at the previous high at around 146.81. I think it's going to make it. I mean, you look at all of these indicators, RSI, MACD, Vortex, all firming up in the bullish destination. I gotta assume the VLO and the refiners will trade at higher highs. Then we'll look at the 10-year yield again. No major move today. Sure, a touch below the 20 days moving average, but no major damage here that justifies the mania in cryptos or the positive activities that we've seen in the XHB and again in the IYR real estate. XHB got to the upper Bollinger Bands, faced some resistance, got a negative reaction, but nothing to see here. The IYR is turning positive, expanding the Bollinger Bands higher. Got a real test at around 90.50. For now, the technicals are really bullish in real estate, but a major pop in the 10-year. We're talking about the 10-year yield. I think it's going to stop the pop in real estate. Watch the volume. If the volume begins to cool off, that means there was probably some short covering, some allocation in real estate, but it's not going to last. You look at the KRE Regional Banks daily chart. Again, boring. It's just within the really tight Bollinger Bands. For now, it is boring, but here's what you got to understand. There is a major move coming in this tight consolidation range. There's a big move coming up or down. I think you know where I'm leaning. I'm leaning down. Am I betting on it right now? Not really. I might miss it, to be honest with you, because I don't want to take the risk right now if the move doesn't happen right away. For now, it's going to be boring, trading range, within the Bollinger Bands, back and forth within the 20 days moving average. But if you feel confident, usually this kind of tight consolidation is resolved with major moves. So keep that in mind. And you look at the VIX weekly chart. We still have bullish momentum, believe it or not. We might make it above the 20 weeks moving average, and if we do, we got a surge in volatility coming in the first real correction in the SPY since the October correction of last year. You look at the Big Kahuna Apple daily chart, what do we see here? Number one, we're about to have the death cross with the 20 days moving average crossing below the 200, the 20 in white, the 200 in blue. Number two, we're getting a little oversold. We have a gap below the lower Bollinger Bands. The RSI is also getting a little oversold. What do we do in this case? Again, if you have shorter expiration options, on the put side, you gotta consider booking some profits or at least rolling for a longer expiration date. You gotta have weekly hedges by buying weekly calls expiration. If you have a serious trade, say the 170 puts for April, what if we have an oversold correction between now and then? You gotta have a hedge against that. If we consolidate here and not rebound right away, odds are that we're going to see the lower Bollinger Bands expanding to accommodate Apple and allow the chart to go down further. In that case, we'll look at the weekly chart. And again, in or around 170, we're going to find really strong support because that is the lower Bollinger Bands. Souffle Tesla, daily chart, what do we see? Did we lose the 20 or not? We did lose the 20 days moving average. That's bad. Now let Dr. Maverick zoom in to the hourly chart and see what's going on. It was looking as a bull flag. But the moment we got to retest the 202.5 in the pre-market session and we lost 199.90. Oh, it was bad. So now we have a flush down. Got a little oversold on the hourly RSI. If you don't make it above 190.59, then probably we have an inverse ABC that will take us down to 180. Then we'll look at NVIDIA hourly chart. Major gap higher. If you did the 1,000 calls for today, you get in, you get out within the same day. Really dangerous if you're going to chase the calls. They'll cost you a lot, and you have to close them really fast. In, out, hello, goodbye. Because they're going to appreciate in value fast. But if there is any drop, as we've seen in the last, let's say, 2 hours of the day, you'll lose value really fast too. The volatility is insane. So if you go into calls, you make enough profits, in, out, hello, goodbye. Because once we've seen the rising wedge, you see the hour sign, the hourly getting really, really overbought. We played the rising wedge. We have a break. Now we have to see if 424 is going to hold the support or not. But ultimately, we're not going to turn bearish in NVIDIA in terms of trading or betting against the name until we lose 771.62. You look at the daily chart. Again, we have a gap outside of the upper Bollinger Bands. That's not good. But NVIDIA has been a really strong momentum name. So we need to see a confirmation of that loss by another red day tomorrow, preferably closing below the gap at around 824. If we do that, then we have damage in the chart, but the confirmation will be losing 771.62. Then we can bet against the name. You look at AMD. Again, you got a gap outside of the upper Bollinger Bands. Well, the bear is waiting out there. Too dangerous to trade outside of the Bollinger Bands at night. And we see a really nasty candle for AMD, worthy of taking a shot against the name. So we did. And if it is indeed the top, we use Fibonacci's help. We can go down all the way to 183. Whether that's going to happen this week or next week, who knows? That is, of course, with the assumption that this is the top, and there is a good chance that it is, at least for now. Then we look at tulips, Bitcoin. What do we see here? Bull flag playing out, massive pop. Now it comes in the hands of these option players. They were betting on the 69,000, 70,000. Will they get really close to 70,000 and then dump? I feel and I smell a major dump coming here in Bitcoin. I think once they get to a specific number, they'll begin dumping big, and we will see a sharp move to the downside. We're not saying Bitcoin is going to crash. We're saying a sharp move to the downside could lead us all the way down to 58,000, could lead us down all the way to the 20 days moving average. And that's not going to be outside of the boundaries of reason. Then we'll look at the proxies, Coinbase, tracking Bitcoin. If Bitcoin goes down, we'll see Coinbase also flushing down. Then we'll look at MSTR, Mr. Daily chart. Out of whack, really overbought, impulsive moves, high volume, tracking the action in Bitcoin. The problem with charts like this is you'll see the volatility to the upside but also the downside. So if we see a correction in Bitcoin, say 5-10%, we could see MicroStrategy down 15-20% right off the gate. So I had a bearish trade on it, and today I did average down. I got time and the trade was losing big. So what do you got to lose? You average down, you lower the cost of entry, and if we have a major flush, the trade will be profitable again. Here's the weird part of the proxies. You look at Mara, the miners, underperforming today. Sure, we got a retest to the 20. We did not lose the 20 moving average, so that's the good news. Bad news, we're losing momentum in the RSI, in the MACD, in the Vortex. You lose the 20, and you have a correction in BTC. Oh, this thing is going to flush down big, maybe all the way down to the lower Bollinger Bands. So it is worth it to take the shot for now, because after all, this could be a topping head and shoulder pattern with the confirmation of losing the 20 days moving average. Let's move on to the conclusion of this video. What do we have in the economic calendar tomorrow? We got factory orders. That's going to be important. And then we have ISM services. That's going to be really important. What's happening with new orders? What's happening with prices paid? Then after that, we have the chair of supervision, Michael Barr. That's not going to be relative to the stock market. I would say all eyes will be in Apple. Is it going to recover or not? All eyes will be in Tesla. Is it going to recover or not? All eyes will be in the chip segment. Are we about to get into a correction in chips that began late today, continuing into tomorrow? And then we have the testimony by Jerome Powell comes Wednesday. Lots to look forward to. But folks, this is all I got for you for now. Hope you enjoyed the show. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
This is cancer, right?